Foreign ownership and the so-called national interest have never been the most comfortable of bedmates, politically speaking. But with the Canadians knocking back BHP's bid to buy their potash reserves and a fresh wave of Chinese takeover action in the West, Singapore's move on the ASX and Woodside potentially on the block again, the debate about reconciling these competing interests has arced up again. Neil Woolrich reports.
From the gas fields of the North West Shelf through Western Australia's iron ore deposits and to the coal mines of the eastern states, foreign raiders have their eyes on Australia's resources bounty. Standing between them and those lucrative prizes is the Foreign Investment Review Board. Based in the Treasury building in Canberra, it's a department which can make or break multi-billion-dollar deals, but whose inner workings are little known and rarely spoken about.
The Foreign Investment Review Board actually has no statutory authority or legislative powers. In practice, it's a division of the Treasury in Canberra which screens applications and then refers important or difficult applications through to the Treasurer.
Norton Rose mergers and acquisitions lawyer Michael Wilton says the vast majority of FIRB decisions are waved through. In those cases that do attract close scrutiny, the key question is how FIRB applies the national interest test. In 2008, Wayne Swan outlined 6 principles to help define the national interest. While that framework has since been replaced by a new policy statement, the national interest test remains loosely defined and based around the widely held community concerns of Australians.
Well, of course, practitioners and applicants and the international investment community would like to see much more clarity. The international community would like to see a more specific test, and probably a test, if there is to be one at all, based on economic considerations. At the moment, because there is no test with any specificity, there is a tendency for political considerations to come into play.
Over the years, FIRB has rarely intervened in foreign investment applications. The biggest knockback came in 2001, when Peter Costello overrode FIRB's advice and thwarted Shell's bid to take over the oil and gas producer Woodside.
I want the people that are marketing and operating the North West Shelf to have not a skerrick of a doubt that they want to put Australia first and they want to get that market for Australia.
That argument came back into focus this week on news that Shell had reduced its stake in Woodside from 34% to 24%, raising speculation the company might again become a takeover target.
Shell must be of the view that if they couldn't take it over, it would be very difficult for others to do so as well, save for one or two exceptions, of which the most often quoted company is BHP, and perhaps they wouldn't have as high hurdle in the Foreign Investment Review Board as others.
It is important that Australian industry and the Australian people have a direct say and participation in major projects. We would be a very foolish country and a very foolish state if we allowed our natural gas resources to be controlled entirely by overseas companies.
But in recent times, it's been China's appetite for iron ore that's generated the most interest. FIRB has approved a record $60 billion in Chinese investments in the last 3 years. However, 2 Chinese bids for iron ore projects have been knocked back on national security grounds, while Sinosteel was also barred from taking full ownership of Murchison Metals. Those rulings, along with some specific guidance notes targeted at government-related firms, have led to suggestions the approval process is biased against Chinese state-owned corporations.
State-owned enterprise may have non-commercial objectives. They may be interested in security of supply, which probably is in our interest to have consistent supply coming on stream and being able to meet that supply. But having prices being determined to some extent by customers is not so desirable.
FIRB's next big decision is likely to be the Australian Stock Exchange's bid to merge with its Singaporean counterpart. Already there's been staunch opposition from either end of the political spectrum, from the independent Bob Katter to the Green Senator Bob Brown. While FIRB is unlikely to be swayed by political posturing, it may well look closely at whether a tie-up with Singapore could weaken Australia's listing and compliance rules.
And there are differences between the way that plays out in Singapore and in Australia. So there is a national interest issue there, and I think, again, it's appropriate for the government to be very careful about making sure that if there is a merger or a takeover, that the security of our stock exchange is maintained.
Although FIRB is widely expected to also approve the ASX deal, the OECD has this year ranked Australia the 38th most restrictive nation for foreign investment in a survey of 48 countries. Analysts argue that result is skewed because Australia reviews every foreign investment above certain thresholds, even though most are rubber-stamped.
I think the main issue there is one of timing. Nearly all applications are approved, and at the time they're made, both the applicants and FIRB know full well they will be approved, and all FIRB does is introduce a 30-day delay to the process. So it would be nice to remove or shorten that process if possible.
Canada sits 3 places below Australia on the OECD's table, and its ranking might slip further after the North Americans blocked BHP Billiton's bid for the Potash Corporation.
I don't think it was a purely nationalistic concern. It was a genuine concern about the competitive landscape if BHP were to acquire potash.
While Canada shut the door on that deal, Deutsche Bank's energy analyst John Hergy says Australia does seem open for business in the oil and gas space, notwithstanding the Woodside decision in 2001.
The most recent action would have been when BG tried to take over Origin Energy, and they explicitly got some FIRB approval. So I think the Woodside decision is rather unique in that context, and we've seen Arrow Energy being acquired by Shell and PetroChina.
But with news this week that the Hong Kong-listed Wanam International is stalking the iron ore juniors Brockman Resources and Ferroz, that open-for-business attitude will again be tested over the coming months.